Hey everybody, welcome. We're just waiting for our technician to come back down here and confirm that everything's being recorded. Mr. Preston, how are you today?
I'm doing well, Tom, and thanks everybody for joining us this afternoon. I think we're gonna have a fun chat today. Okay.
Ben, we all good? Ready to start? Perfect.
Excellent.
Excellent.
We have our experts setting up everything for us. So, okay, Tom. So, what do you think of the market today?
Well, hold on, Mr. Preston.
Yeah.
I know you're a stranger to these Wednesday chats right now.
Well,
So.
for a while, yeah. Some of the old folks remember me, but anyway.
Tom Preston is one of the principal architects of Thinkorswim. Tom and I started to build this platform together about 10 years ago. So
Yes, we did.
there's not a piece of functionality in there that Tom is
Hasn't touched.
hasn't touched.
Is a gentle way to put it.
I don't like the way that sounds. It's
It's a little too personal, I understand.
yes. Anyway, let's talk first, Tom. Just a little. We always do a little bit of housekeeping when we first come on the Wednesday afternoon chats. By the way, we had I don't know if you listened to the chat last week with Jack Pedrosian. It was very interesting, different type of chat. A lot of great feedback.
Very
For those of
popular.
you that missed it, because we didn't quite have the same numbers we usually have, but it was a really popular chat, and we're gonna have some other interesting speakers on. Next week is Ken Wood from Woody CCI talking about pivots.
Faz cafezinho pra mim.
We are bringing in Timothy Sykes in about, I think, 2 weeks, or maybe not 2 weeks, maybe 3 or 4 weeks. And Tim's going to be here to talk about OTCBB and bulletin board stocks. He's a riot. We're also bringing back Tom O'Brien. I do the Tuesday morning radio show with Tom, and he's great. And he'll be on in August. And then we're planning on we're working on bringing out Peter Reznicek actually to talk about who's the original shadow trader, to talk about some of the new pairs trading technology that we're building, and Peter's been intimately involved with, so we're kind of excited about that. And I haven't had a chance to work on dates yet with Peter, but hopefully, we'll get something set up for some time in August. So those of you that are kind of old Shadow Trader fans and Peter Reznicek fans will, get Peter onto one of the. I think it'll be the first time he's ever done a Wednesday chat. So
Maybe the second time.
maybe
I think
second
he did
time.
one a few years ago.
In September, we've got Tim Knight lined up to come out to Chicago to do a Wednesday chat, and then we've got a couple of other interesting kind of personalities from the industry coming on. So there's going to be some great chats coming up. We like to bring in guest speakers every other week, and then kind of on the off weeks, we like to do them here and talk about stuff internally. In 2 weeks' time, we're actually doing one of our favorite episodes, or our favorite sessions, which is we're actually going to be introducing different trades for, showing about 7 or 8 different trades going forward, looking for August and September. So got some neat stuff.
So the kind of like the summer doldrum types of trades, or the second half of 2009 types of trades. Those are always great chats to join in with. Very educational, and gives you a lot of food for thought when you're actually trading.
So a couple little updates here. The iPhone application was launched. The new iPhone application was launched this morning. It was turned over to the App Store. It will take them a couple of days. We're hoping
They need to vet it. They need to make sure that everything's kosher with it and everything like that.
it is so cool. Even a non-technician is loving what our team built on this one. 250 different studies on an iPhone. I think that's the final number that we launched. 228 or 248. I don't remember what it is. 248 different studies. I think 4 different time frames. Streaming news, streaming charts in a real cool little format, and then as well as multiple audio channels on there as well.
Yep.
Right now we have a lot of people listening to Shadow Trader through the iPhone, but we have a couple more different surprise audios coming out as well. So that was rolled out today, delivered to Apple this morning, and any day now, as soon as they approve it, we'll post on the site and post a message out there. Other than that, a lot of other stuff in the hopper, Tom, but I'm going to wait actually a week before we start showing them. Tom and I have been working on some stuff that's Is it fair to say, Tom, we're going to blow their minds in August and September?
It's double secret probation sort of like stuff. We can't. We would love to give you hints, but these things are game changers. These things are game changers.
We're not going to spill it here. We're just going to throw out a teaser that says one of the things that we're working on is something that nobody's ever done before, and I think it's a game changer. I think it's going to be the most amazing piece of technology we've ever rolled out there. And right now,
it'll be fun.
It'll be fun. Right now, we're targeting for August, September. Yep. I don't know. It may be more complicated than we think.
Yeah. Well, Tom Sosnoff and I, we don't actually write the code. We just come up with the ideas and write the specs and all that. So it's, sometimes we say, can we get this done for the July release? They shake their head. How about August? Come on, guys, August. So it's a little bit of give and take. And we're going to get some feedback on the specs tomorrow and Friday. And we'll see if August is likely or not. I'm keeping my fingers crossed.
We have one of our best developers on this, and it's going to be a lot of fun, except he doesn't talk to Tom and myself anymore.
That's right.
We've pushed a little too hard over the years. Anyway, so we have a great session today, Tom. This is, just so everybody knows, and I usually wait till about 3:30 to get it to start with this, but today's session is a piece that I wrote for if anybody here has ever seen Option Action. It's a Friday night session that we do, starring Melissa Lee. She's the host, and it's got 4 different guests, not really guest speakers, but 4 different panelists, and they talk about all this option stuff. It took us about 6 months before we could train those guys. Unfortunately, they wouldn't use any of our people.
They didn't come to our classes.
They didn't come to our classes.
They didn't,
They were too smart to learn. They were too smart to learn. They were geniuses, and you can't disturb delicate geniuses. But after about 6 months of training, we finally got them to the point where they actually understand the concept of what we want to teach. Melissa's been great all along, and some of the guests have just been awesome on there as well, or some of the panelists, but they're really getting good right now. Well, one of the segments I introduced to them, which took them about a month to figure out what we were trying to do, was called Good Trade, Bad Trade. I also rolled that out at our high probability class in Chicago.
Yep.
Maybe probably a year ago, and I touch on it every time we do the class. But Tom and I were thinking today, there's just too many questions. We both get tons of emails. There's just too many questions with respect to, hey, here's what I'm trying to do, but what's the best way to do this? So what we've been doing on Option Action on Friday nights, and what we've been doing, through our high probability class and through other classes that we teach is, and we don't have a lot of time to do it today, but we thought we would go through some real live examples. There are good ways and there are bad ways to approach a strategic objective with respect to the markets. This has nothing to do with technical analysis. This has nothing to do with fundamental analysis. This is after you've made up your mind.
This is after you have a bias. You have a bullish bias or a bearish bias, or maybe even a completely neutral bias. But that's still not a trade. Okay, just because you have an opinion on something, that's still not a trade. You've got to be able to find, what are you going to buy, what are you going to sell, how are you going to express that speculation. And there are smarter ways to find those trades, and there are some less smart ways of finding those trades. And so we're going to try and give you, our approach at what we think is maybe the smarter way of choosing some of these directions.
Well, options are a fascinating financial instrument, and as you've heard me say many times through many different lectures, you can what makes them fascinating is that you can essentially set up your chances of success are completely mathematical, and you can basically put yourself in a position where you have unlimited upside, but even if you're right, you can lose money. You can also put yourself in a position where you have either limited downside or reduced downside, but even if you're wrong, you can still make money. So they become a very unique vehicle in the sense that if you look at stocks, if you look at futures, and if you look at like spot FX, for example, you either have to be 100% right or 100%, you're 100% right to make money, and if you're wrong, you lose money.
It's a flip of a coin. In other words, if you just buy, let's say, spot euro, euros versus dollars, or just buy spider shares or gold futures or something, They go up, you make money. They go down, you lose money. It's as simple as that. It's very black and white. And so all the burden is on your directional or direction picking ability. The trades that we talk about, the way I like to approach those sorts of trades, take some of the burden off of that. That means I don't have to be as correct as I would with just a straight stock or futures or forex trade.
So here are the advantages. So one of the things that we said, now again, let me repeat that one more time before we get into the actual, because we're going to give actual examples of this throughout the next hour. But again, you can be right trading options, meaning that the stock you pick, XYZ stock, is currently trading for $25. You think it's going to go up. You don't know how far it's going to go up, but you want unlimited upside. So you buy the 26 calls. The stock goes from 25 to 26. So on paper, you're right. But it doesn't go there fast enough, and the time decay offsets the appreciation in the stock. So net, your stock's trading 25. You pay $1 for the 26 calls. The stock goes to 26, and the 26 calls go to 50 cents. So you're right, but you lose 50 cents. It happens all the time, and it's one of the disadvantages of unlimited upside. It's called leverage, and it's one of the disadvantages of unlimited upside. The same trade, okay? The stock is trading for 25. XYZ stock's trading for 25. You, instead of getting unlimited upside, you sell the 24 puts, 1 point out of the money, and you collect $1 for selling the 24 puts. So instead of buying the 25 calls for $1, in this case you sell the 24 puts for $1. They're $1 out of the money. You still think the stock's going to go up, but in this time the stock doesn't go up, it actually goes down. Stock goes from 25 to 24. So you're completely wrong. But at the same time, it takes a while for it to get from 25 to 24, and the 24 puts go from $1 to 50 cents. So you're 100%, you're completely wrong. Stock drops $1 instead of going up $1, but yet you still make money. Okay, now you had limited upside by selling those puts. The most you could make was $1. You had unlimited upside by buying those calls. You could make as high as the stock went.
Right.
But that's a little bit about risk reward. That's what today's session is all about. Tom, are you ready?
The helmet is on.
The helmet's on?
The chin strap is secure.
Are your seatbelt buckled?
It is now.
Okay.
My 5-point harness is secure. Let's begin.
Beautiful. Here we go.
All right, what's the first stock in the docket?
First stock we're doing is UNG today.
The natural gas ETF.
Well, you know what? It's not a stock that's in the news. It's a stock. Here, let's go to the charts because everybody needs to see a picture.
And that's fine.
So here is a very ugly picture of a stock that was recently trading as high as, let's call it $70, $60, I don't even remember, $60, $70, and here's a stock that's now down to $12.20. It's a stock that actually stopped trading yesterday. It's a stock that was in the news. Now the government is going to stop you from speculating, and gas prices are going to go to...
Well, we don't quite know the form that's going to take, but there's some talk of legislation that's going to restrict the speculative interest in a lot of these products.
What better time to trade a stock that is speculative in nature as when they're talking about eliminating all stocks that are speculative in nature. Not stocks, but products. Anyway, so it stopped trading yesterday. A lot of bad news. As you can see here, I love you know how we've been trading. You know how we like to trade. This is a stock that's come straight from basically from $16.50 to $12. It hasn't even had an uptick. And here you can read about
a week and a half.
You can read about all these people now, chatting in, it's the end of the world, it's da 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 da. Listen, I love trading, and I don't really care what the underlying is. This is in a situation of General Motors, and if you can trade natural gas, you can trade the futures on Thinkorswim. It's /NG, and they're essentially making new lows every day. Here's the corresponding future if you just want to see it, because I think it's fair to put this up rather than. Oops. Oh, you know what? There's some bad ticks in here.
The UNG? Here, let me.
You know what? I don't want to waste time taking off all those ticks. Let me just. Yeah, I'm going to go back to UNG. I can fix that later. I didn't realize there was bad ticks in there. I will fix that. couple of bad prints in there. Anyway, so, but you'll see the natural gas futures are down by their lows. But anyway, just here's the chart picture. I really don't care, just to show you. A couple of weeks ago we came on here and we said, look at Microsoft that has 14 straight up days, and everybody said, oh my God, it's the strongest trend I've ever seen. Oh my God, how could you sell stock into that kind of strength? Well, now the stock, traded into the low 22 handle today, so it, dropped 10% in the last 2 weeks since we've been talking about it. So sometimes you just have to, trust your contrarian instincts. And so here's another case of, I could care less about UNG, but I'm just trusting my contrarian instincts for the purposes of today's discussion and today's discussion only. So first thing we do is we teach you that forget about July because there's only 9 days left, so we're going to open up August options. There's 44 days left to go to August.
That means they have some option premium worth. They have some value left in those.
So let's think about some things that we like about UNG for starters. 1, it has single point strikes. 2, it has 71% volatility. 3, it is at the low end of any range that it's ever traded in. So it is, natural gas is down to historic, basically at or near historic lows, and UNG is trading the same thing. So lots of different reasons for a contrarian to get involved. But Tom, if I wanted to go out, I think the stock could rally back to $15 by August expiration.
It could very well.
I think it could rally to $15 or $16 by August expiration.
Could do
now,
that.
Of course, could it go to 8? Of course. But I think the stock could rally.
It could go to 2. I mean, you don't know any, but if you speculate that it's going to go higher.
So let's just say we think the stock's going to go higher and it could bounce back up to $15 or $16.
Yep.
If I was to go out right now, one other thing to notice here, and one of the reasons we picked the stock, notice today's volume in August options in UNG. On the call side, almost 3,000 of every single strike traded, and notice the open interest. It's almost 11 or 12,000 per strike. So you have huge call volume, and you have actually huge put volume. So this stock is in play. It traded 38 million shares. Now, you'll always hear me on these discussions talk about liquidity. So the first thing we look for is this underlying that we're about to trade liquid? Answer is yes. During the day, the stock market in there is 1% wide. It trades 38 million shares. Also, volume, couple thousand on each side of the market, open interest, plenty. So this is clearly a stock that's in play. It has high volatility, it has single point strikes, and it meets the, quote, contrarian criteria that it could have a bounce here after being soft for about 15 straight days. Call it a full moon low. Call it whatever you want, Mr. Preston. But is the play then, because I think it could go to 15, is
buy
the
some
play,
out of the money calls?
Well, is the play, let's just talk about this for a second, is the play buying the 13 calls? Now, I'll give you the rationale for buying the 13 calls. Oh, boy. I cannot change this on here. I will give you the rationale for buying the 13 calls. And the logic behind it is, unfortunately, when I'm on the video, you cannot change the default column. So can you please tell me what the probability of expiring at $14 is?
14, 25%.
So there's a 25%, and I'm sorry for not being able to display this. It's just the mechanism we use for transmitting this this broadcast. But according to Mr. Preston, the chances of getting to $14 by August expiration is approximately 25%.
That's right.
That means if I was to buy the 13 calls at 90 cents this afternoon, my chances of getting to my break-even number,
which is 13 plus the price of the calls, or about 13.85.
13.90. Let's just say.
Yeah.
So that's why I asked you what the chances of me getting to $14 are.
That's exactly right.
If the chance of getting to $14 is 25%, or let's say the chance of getting to $13.90, which is my break-even, is 27.5%, that means that I have a 72.5% chance of losing on this trade.
Yep.
Now, that's not completely accurate because that's by expiration. So between now and expiration, the probability of touching $14, which means that the trade will be profitable, is about 2 times that, or just let's call it about 50%, 52%.
A little higher than 50. 52 is pretty close.
Okay.
Yep.
So what you're learning now as traders is that, and forget about all this stuff. Don't read these chats on here that talk about the decays because of Contango and all this stuff. Just think about it as, hey, it's a trade.
This is something that you think is going to go up or not crash. Okay? That's what it is. So if you think it's going to go higher, most people would look for a cheap option. Most folks are going to look for an option that trades less than $1, and they say, well, gee, even if they don't know the probabilities, they'll say, gee, it costs less than $1. Tom, for Pete's sake, the max risk is $90. How can I go wrong?
Well, you go wrong because you have a 72% chance of losing on the trade. So even if you're right, you go wrong. But now let's think of different ways to play this to play the upside in here where your chance of winning is 50-50 or better. In fact, where your chance of
Better
winning
than 50-50.
or better than, well, where your chance of winning means that you can make more than you could potentially lose. So I'll stay to the call side of this underlying, and for starters, okay, we'll look at the 12-14 call spread. And the reason I say that is because in the criteria that we teach, I don't have a lot of time today to get into everything we teach because we have so many stocks that we want to cover. But we teach when playing the upside or buying debit spreads, you want to buy something that's one strike in the money, and you want to sell something that's essentially one strike out of the money. So I'm going to take my cursor, I'm going to go to the August 12 calls, going to move my cursor to buy, going to move my cursor over to vertical and left click on vertical. Then I'm going to change the out of the money strike to 14. As you can see, the out of the money, the in the money 2-point wide call spread trades for about 73 cents. That's the mid price. The natural is 80, so you probably buy this around 75 cents.
Yeah, that's what I would guess.
Okay, so you pay 75 cents. Now, instead of your risk being 90 cents on the out of the money calls with a 72% chance of winning, in this case, all you have to get to break even on this trade is 12.75.
Yep.
Tom, what are the chances of getting to 12.75?
On the, well, let's make it 13, let's say.
Let's make it 12.75. You can interpolate.
Well, all right, let's make it about, it's about 40%.
It's
38%.
A 12.75 can be a little higher than that.
13 is 35%.
Okay, so let's just say, what'd you say?
About 38%. Let's say about 38-ish.
Say 38 to 40% is your chances of getting to 12.75. But now you're risking, you're risking 75 cents to make 125.
That's right.
Okay? So now you've changed around the risk metrics. It's a very different animal right now. Now you have, now basically, okay, you went from a situation where you have a 72.5% chance of losing to now we're in a situation where you essentially have about a 65% chance of winning.
Right.
A little better, 67.5% chance.
And you're doing that by buying an option with a little bit more meat to it. You're buying a slightly in the money option. It's got a little bit of delta to it. It's going to go up if the stock goes up. And you're hedging that and reducing some of your risk by selling it out of the money call against it. That's kind of the way you approach that particular way of looking at it.
The reason I didn't mean to say 67% chance of winning. I meant to say you have a 67%. Your payout is 67%, 33%.
Correct.
So what you basically end up with is risk $75 to make 125 with a 40% chance of winning. It's a very strong risk reward.
Right.
If you're trying to play the upside. So essentially, what you give yourself here, it's not you have paying a little bit of extrinsic premium, but for the most part, with the stock currently trading at 12.20, you're only paying 55 cents over instead of 90 cents over, and your break-even price goes from 13.90 all the way down to 12.75. Okay, so it's a very different set of risk metrics, and we much prefer buying the 2-point wide call spread, one in the money, one out of the money, as opposed to buying the out of the money call. So in the first example here, the good trade is buying the 12 calls, selling the 14 calls. The bad trade is buying the 14 calls outright. I'm sorry, the 13 calls outright.
Right.
So again, let me repeat that. If you're bullish in UNG, because what you're looking at lines up, the good trade is the 12-14 call spread. You risk 75 cents to make $1.25. You're only paying 55 cents in extrinsic premium, and your break even is 12.75. The bad trade is buying the 13 calls for 90 cents, where your break even is 13.90, and you have a 72.5% chance of losing. That's good trade versus bad trade. Bad trade buying the naked call. Good trade buying the in the money call spread.
Yep.
Now, Tom, let's take it one more step, and then we'll move on to lots of different trades. But the next step here would be to take a look at this and say, well, let's say I wanted even a higher chance of success. And I was willing to take, I don't even care if I make $1.25, and I have enough capital. The one thing nice about buying the call spread is you only have to pay the debit, which is $75.
Yep.
If I wanted to use more capital and have a higher return on risk and return on capital, one of the things I could do, Tom, would be to sell the nearest out of the money puts.
Yep.
Which are the 12 puts.
That's right.
If I wanted to. Now the 12 puts right now are trading for, let's say, $1.05. And now again, this is just, you can even sell the 11 puts in this case because they're 60 cents. But if we were to sell the 12 puts, Tom, the break-even price would be $10.95.
Yep.
What are the chances of us getting to $11?
38%.
38%.
Yep.
So if you're to sell the 12 puts, the chances of you staying above your break even are 62.5%.
Right. Basically, 2 out of 3 scenarios. Now, there's 2 out of 3 instances, 66% of the time, you're going to be above the break-even point of that trade.
So this becomes the great thing about options. This becomes, last week we talked about all the different markets. A couple weeks ago we talked about tape reading. In between that, we sandwiched a session on technical analysis. But ultimately, the key for every single one of you to be a successful trader is that you know what you're doing with respect to the strategy that you're applying. If you apply the right strategy and this underlying does what you think it's going to do, you have to make money. If you apply the wrong strategy, you're always scrambling. So here the example is, you have enough capital, meaning that you have approximately 20% of the price of the underlying strike price, or the break-even price, which in this case is $11. It's the strike price minus the credit received.
Yep.
So let's just say it's $11. It will require approximately 20% of that, where for each one lot about $200. It's actually a little less.
Yeah,
but
about $2.20. Well, less than that.
It'll require about $200 per one lot, and the return on capital for that specific period is $100.
Yep.
So it's a 50% return on capital. Pretty interesting.
That's not bad.
For 44 days.
Yeah,
With a 62% of success.
Of
But you're
staying above
limited,
that
you can only
break-even.
make $1.
Right.
So in this case, the good trade, selling the 11 puts, if you have the capital available, selling 11 puts, it's not return on risk, it's return on capital.
Right.
Return on risk is obviously significantly smaller because the return on risk is about 10%.
Yeah,
but
the stock can go theoretically to zero. Your risk in that is what, $10? That's
Right.
what it is.
Well, $11. So you're risking $11 to make
$11. Excuse me, $11.
Risking $11 to make $100 is basically a 10%. Let's just call it round it up to a 10% return on risk, but it's a 50% return on capital for 44 days. That's the good trade. The bad trade, buying the 13 calls.
Right. Right.
Okay.
So again, these are bullish trades, and again, we're not really commenting on the quality of whether the UNG is going to go up or not. Tom and I both think it might go up. You might disagree, and that's fine. But we're not arguing about the direction. What we're arguing about is how you express that in the choice of the trade you make. And so we went through 4 different trades, or 3 different trades. Each one had either more pros than cons, and those are the ones that we suggest you start thinking about a little bit more. So in order of preference, yeah, you've got the long call, long out of the money call. Not a very smart way to express a bullish interest in UNG. Long call spread, a little bit smarter.
So,
short put, maybe smarter as well.
So one of the Tom and I are like twin. We're not like twins.
Frickin'
actually.
no, please don't say that.
Yeah,
That's
we're the twins. What was that movie with
Frickin'
Danny
frack.
DeVito and
Arnold Schwarzenegger.
no twins? Right.
Twins.
We're those kind of twins.
Oh,
But I'll be Arnold. Anyway, so just to recap those two.
Overseeing the bankrupt state.
Just to recap those two. Bad trade in UNG, buying the 13 calls or buying the out of the money calls if you're bullish. Good trade in UNG, buying the 12 calls, selling the 14 calls, and buying that debit spread for 75 cents, or selling the out of the money 12 puts for $1.05.
Right.
Okay, now that's a interesting start. But one other thing that we didn't talk about, we've been discussing a little bit of the reasons why we liked UNG. Stock's oversold, it's down to a low, high volatility, just decent open interest. But then one of the things we've been harping on session after session and month after month is we've been talking about the market being in a trading range. And one of the trading ranges that we've talked about, Tom, was 945 on the high side and 877 or 875 level on the low side. Well, today we broke down right below that 875 level. We basically closed wrapped around support. And listen, as a trader, the hardest thing to do is buy them when they get to support and sell them when they get to resistance. Any monkey can look later on and say, hey, I should have sold them up here, or hey, it was a layup to buy them down here. But to actually do it and pull the trigger is damn hard. And to actually talk about it on an afternoon chat session is even harder.
To support it in archives?
Yes, and to support it in archives because every single person's out there saying, I got you right here saying we hit this. And, listen, it's not easy. Trust me.
But that's being a trader.
But that's what we do. It's a fun stuff. So, anyway, one of the other reasons for talking about this particular trade is just that, we're kind of down to support level. Now, I don't know if we're going to stay there, but we're, wrapped around support. So, Tom, I am now going to move on. Take you to the next stock. I'm going to stay inside of this little energy sector for a few seconds, and I'm going to get to XLE.
XLE, a fine energy sector ETF.
Well, actually, I don't care about it at all. I mean, for me, XLE is just another name in a long list of names.
Long list of names with very liquid options. Tight bid-ask spreads, a lot of open interest, a lot of trading volume.
So 34 million shares traded, penny-wide
Nice
markets.
product.
Again, we're going to go to August options, Tom, because July's only got 9 days left to go.
Yep.
There's plenty of time to go to August. We're going to look at the volume that traded in there today. And today's volume in XLE, looks like the at-the-money strike at the 45 level was about 2,500 contracts. So there's plenty of underlying.
Yep.
If you look at the open interest in August, there's a couple thousand in each strike. We're in pretty good shape, right?
I like it.
Here, we'll take a quick look at the charts for everybody that's online today. Here's a picture of XLE. And as you can see, it's a pretty little ugly chart pattern. So for those of you that were talking about contango and all the stuff with the last trade we just looked at, take a look at XLE. It's almost the exact same. Wow,
Yeah.
It looks just like the market. It looks just like, this is just another picture, very similar. But look at today's bottom. That's, you can call that little doji. You can call that whatever your candlestick book.
Gravestone Doji.
That's not a gravestone doji.
All
but
right,
it's
I don't
a
know what a
doji.
gravestone Doji is, but I'd like that name.
It's not as good as the abandoned baby, but it's a good
Abandoned
name.
baby bottom.
Okay, but it's an interesting pattern down here, and it is definitely definitely a warning sign. And after 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, basically after 14 or 15 straight down days, all the way from the 52, 54 level,
Yeah.
I think we may have found a little support at the 45 level. And if you go back in time, for all you technicians, and you go back basically look at May and April, you'll see some support in this. Let me pull it up here. You'll see your first level of support around the 45 handle, and then you'll see a little bit more support down around the 42 level or something. But
Yeah.
you know what? Again, I think we're range bound. I think it may be time for a little bit of a relief rally here. And I've been a bear now for 6 straight weeks, so I haven't been that far off. And actually, the calls have been pretty damn good. But let's just take a look now. We're going to go to XLE, and we're going to open up on the August options. Now, Tom, I am one of those that believe that I kind of think XLE is going to go higher, but I'm instead of buying a call this time, I'm going to sell a put spread. But the put spread that I'm selecting here, okay? The put spread that I'm selecting here, I'm not
Yep.
sure if it quite meets our criteria.
Well, let's fire it up.
I'm
What do
going
you
to
think
sell the
about so far?
45 puts,
Sell the 45s,
And-
slightly in the money.
slightly in the money, and I'm going to buy the 43 puts.
Okay, so a 2-point put spread.
A 2-point put spread. Now, again, many will argue that the 2-point wide put spread is very similar to the 2-point wide call spread, and selling the in-the-money put spread is very similar to buying the in-the-money call spread,
You mean buying the 43-45 call spread,
Or-
similar to selling
or
the
in this case, the
43-45?
44-46, or whatever it may be.
Okay, all right.
But I am going to argue that as a matter of criteria, we do not like to teach to sell in-the-money put spreads. As a matter of criteria, we'd like to teach you to sell out-of-the-money put spreads, just so that every time you make a trade, you do the same thing. You're consistent throughout.
That's right.
So the trade that I put up here of selling the 45-43 put spread would not be something that meets our criteria.
No.
Okay,
Consistency
even
is
though I'm
important.
bullish.
Well, right, but its consistency is going to give you the confidence to actually take action when you see these scenarios, and you say, well, everybody's, the sky is falling, or maybe, you're trying to pick some inflection point in the market. It takes a certain amount of courage in your convictions, and being consistent will add to that courage.
But the corresponding trade of buying the 44 puts and buying the 44 calls, and selling the 46 calls, of buying the 2-point wide call spread for 95 cents does not meet our criteria.
Yes, yeah.
And even though these are synthetically very, very similar, in fact, most market students will argue that they're virtually the same thing. We're going to argue here that it's not, that it's a function, that good traders are a function of good training, good traders are a function of good discipline, and good traders always do the same thing. So we want to see you buy the 44 calls and sell the 46 calls rather than sell the in-the-money put spread. Now, Tom, if I was to go and sell the out-of-the-money put spread, the 44.42, would
Yeah.
that fit our criteria?
Well, close, but generally speaking, I'd like to go at least one strike away on the downside.
Well, this does, this, you're right. And one of the things that we like to do is we like to go to the strike price that is in the mid-30s,
Yep.
probability of getting there.
Probability of being in the money, right?
But we also like to collect approximately one-third the width of the strikes.
That's right. So it's a balance. It's a balance. So there's not one single thing that you look at. It's a combination of probability numbers plus the credit, plus the risk you're taking, and it all sort of. And that's why there's no cut and dry answer. Well, is it the 42-44 put spread or the 41-43? You could make an argument for either one. And when we have customers say, well, which one is better? There's no better necessarily. You can make an argument for each one.
You just want to collect approximately one-third strikes, the width of
Mm-hmm.
In this case, I would sell the 44.42 because I think we're at the bottom of the range. Now, let me explain that a little bit. If I thought that the XLE was going to go higher, but the S&Ps were at 900 rather than 875, and I thought the bottom of the range was 875, would I sell the further out of the money put spread to give myself more cushion?
Yeah, I mean,
this is where
you might go out to, let's
play.
say, 40-42 or something if you wanted a couple of bucks of downside.
But this is where price action, Tom, comes into play.
Yes, that's exactly
Because,
right.
People say to me, well, how do you know which one to choose? Well, it depends where you are in the cycle. So, for example, if the market just came down from the 940 level in the S&Ps and we dropped 30 handles and we were trading at 910, and all of a sudden you said, I'm bullish in oil, which put spread do I want to sell? I would say, well, are we at the bottom of a trading range? If we're not, then I'd go further out of the money because I'd still think there's some downside. If we approach the bottom of a trading range, then I think that the downside is somewhat limited, even though I could be completely wrong. We break through tomorrow.
That's right.
But go ahead.
And partly because the S&Ps and the XLE are related. They have a high correlation. They're not decoupled. They're not independent markets. So the big oil companies are part of the S&Ps. They're a significant component of the capitalization. So you're not going to see a huge divergence. What Tom is getting at is that I may be bullish on the XLE, and that's fine. That's one part of the trade. The next step is to say, where do I position that short put spread? Let me take a look at the broader market. Let me take a look at the S&Ps. Let me take a look at the Dow. If we were trading at the top of the range, and I think the S&Ps are trading in a range from here for probably the next month or so. If we were at the top of the range, I'm going to think maybe the S&Ps could come back a couple of percent. And if that happens, it's very likely the XLE will follow, just because the XLE and the S&Ps are highly correlated. But if I think the S&Ps are at the bottom of their range, it's going to give me a little bit more confidence to keep that short put spread closer to the at the money in the strike. So XLE is 44.5. I'll sell the 42.44 if we're at the bottom of the range. If we're at the top of the range in the S&Ps, maybe I'll do the 40.42 or the 41.43. It's like when you're playing darts and there's a slight breeze and you just adjust your throw a little bit. Okay?
You play darts outside?
I try to as often as I can. Darts for me is a contact sport, Tom. It's best played outdoors.
I'm going to ask everybody listening to disregard that last darts comment.
Yeah, we'll edit
it's
that
an
out.
insult to all dart players everywhere. But that aside,
Somebody left a window open at the bar.
all that aside, it's important. What Tom said is really important, that you take all market considerations, all market factors into consideration. So, for example, I have been talking about this market being range bound for months. I have been talking about the need to be short premium or have positive theta in your account for months. This is a market that every time premium pops its head up or volatility pops its head up, it should be sold. This is a market that every time we get to the bottom end of the range, you've got to nibble on the long side, and every time we get to the top end of the range, you've got to nibble on the short side. And every time somebody says, oh my God, we're going to break through and go to 1,000, or oh my God, we're going to break through and go to 800, like you're hearing today, you kind of get the feeling, you know what? We've got to be back down to the bottom of the range. That's just a contrarian talking.
Right.
We had a chat a couple weeks ago on price action. This is what it's all about. Today, there were a lot of signs in the market. It was really interesting to me. The NASDAQ turned around at about 2 o'clock today. And if you we're watching the market as S&P's made a new low, not new low, but got close to the low, down 12 at about 2 o'clock. NASDAQ was only down 9. And earlier when the market was down about 12 or 13, NASDAQ was down 14 or 15. So then all of a sudden, when S&Ps were still down 10, the Qs were back up on the day. Then you started to see Microsoft turn around, and it validated to where it was only down 8 or 9 cents. You started to see a lot of different stocks turn around, and if it wasn't for Goldman Sachs, which really kept the hammer on the market most of the day,
we would have been up bigger on the
you
S&P.
saw a real turnaround taking place behind the scenes. That's what it's like to start to watch tape action. You saw a contraction in volatility across the board. You saw this market act much more like a range-bound market. You saw buyers start to bottom pick and step in. Now, what does all that mean? It just means that you stick to your guns and you put positions on that allow you the time to be right. So getting back to XLE now. The bad trade, buying the in-the-money put spread. I'm sorry, back up for 1 second. Roll that back. Selling the in-the-money put spread as opposed to selling the money out of the money put spread.
Yes.
So if you wanted to get long the stock, you sell the out of the money put spread, not sell the in-the-money put spread. If you wanted to get long the stock, you buy the one strike in the money call, you sell the one strike out of the money call. That's one way to get long. You don't buy the out of the money call in here. So the bad trade, buy the out of the money call. The good trade, buy the in the money call spread. The bad trade, sell the in the money put spread. The good trade, sell the out of the money put spread. Now I'm also going to show you one other type of iron condor in here, because this is a single point strike, an inexpensive stock, and I'm going to show you a little iron condor here that would qualify as a good trade. Because if you think we're at the low end of the range, you take your cursor, you move to the nearest out-of-the-money strike, which is the August 44 strike. You move your cursor to sell, you move your cursor over to Iron Condor, and you left-click on Iron Condor. I'm going to go a little slower this time. I am sorry. I was, you said, Tom, they asked me to go slower for us Texans, but you're a Texan.
And I'm a little sluggish. Feeling a little slow.
But
anyway, all right, let's get on to the Iron Condor. Let's keep it on trading.
Okay.
Because we it's fun to talk about trades, because this is how you learn. And what you're learning today is just an approach you can apply in any market condition. So you don't have to be scared. If don't be scared off by what you hear on TV. Don't be scared off by what you think is bad news or whatever, because there are opportunities all the time. You just have to know how to sniff them out a little bit and to apply these sorts of strategies in a consistent way.
So Tom, I thought I'd have a little fun with this, and I put an Iron Condor up in front of everybody so that you can see right in front of you. This is an Iron Condor in August for the XLE. Now this is a bullish Iron Condor.
Yep.
Now this is a trade where you would consider putting this trade on if you had limited capital and you wanted a trade where you took in the most amount of premium with the least amount of risk. Okay? Reasonable premium, reasonable risk, your potential to make $1, to lose $1 with no upside exposure. Your break-even price is 43. What is your chance of getting to 43, Tom? By
43
expiration.
strike is, drum roll please, 43%.
So there's a 43% chance of getting to 43 by expiration in August in XLE, which means this is an Iron Condor where you're risking 97 cents to make $1.03 with a 57% chance of not losing.
Yeah.
So you have no upside risk whatsoever. Stock goes to $1 million, you don't lose any money. Stock goes to, it's 44.5, so the stock can go all the way up to 48 here, which is 3.5 points, which in this case is
like 6%.
6 or 7%.
Not quite so. Yeah, about 7%.
Yeah, 6 or 7% rally in the underlying stock, and you still keep all of this money. So it's a nice risk reward. It's got a 57% chance of not losing, and you're risking 97 cents to make 103. This is what we consider to be a good trade. A good Iron Condor. This is a directional Iron Condor.
Slightly unbalanced. So you're doing a 2-point put spread and a 1-point call spread.
It's definitely unbalanced.
Because you're taking in at least $1 credit for this trade. Midpoint's $1.03 right now. Maybe execute that at $1.02 or $1.01. So you're taking in a larger credit than the maximum width of your call spread. So in this case, stock goes to 100. Your call spread's worth $1, but you took in, let's say, $1.02. So you still make a little bit of money. On the downside, that's where your risk is. XLE goes to 40. Okay, your put spread is worth $2 at that point. You took in $1.02. Your risk is about $100, $100 per spread.
Perfect.
Okay?
Anyway, I'm just pointing out a good trade with respect to Iron Connoisseur. So let's say, Tom, because there's a lot of people on here that actually like to take a lot more risk. So let's do something that we've never really talked about from a risk perspective on here. I'm going to go to August, and I'm going to say the same thing. Let's just say that you wanted to sell the naked put. Okay, and let's just say you went to the 43 put,
Yeah.
and you wanted to sell the naked put in XLE.
About $1.75.
About $1.75, right? So you wanted to sell one naked put in XLE, because if you sold one naked put, you'd have to put up in capital, in this case, about $740.
Yeah.
$750 to make $1.75. Decent risk reward if you're bullish on this. But let me
Yeah.
ask you a question: would it be then okay to go out and sell an out of the money call, even though you're bullish, to go all the way up, for example, and sell the 48 calls for 95 cents? What would be the advantage of doing that?
Well, let's see. You're taking in more credit.
So you're adding to your $1.75 an extra 93
That's right.
cents.
You're taking in more credit.
95 cents.
You're actually widening out your break-even point on the downside.
Okay, so let's talk about that really slowly.
Yep.
So for starters, you sell the out of the money put because you're bullish.
Yep.
Stock starts to bounce up a couple of pennies, you go out and sell the out of the money call. You take in an additional 95 cents.
Yes.
That changes your risk reward because that changes your break even price, which is now $2.70 wide.
That's right.
Okay.
That's right.
So you add 270 to your short call strike, which takes you all the way up to basically just under 51, and the chances of getting there are what?
51. Let's see. Me have just one more strikes. 12%.
12%. So you have an 85% chance of making money if the stock goes to the upside.
Right.
And to the downside, takes you down another whole strike, so it probably takes you down to about
Down to 41, which is about a 31%.
31% chance. So basically, it changes your risk metrics. You break even to a 70% chance of making money, even if the underlying goes down, and an 85% chance if the market goes up by selling this triangle. And here's the cool thing: it requires no additional capital.
That's right. Now, why is that? Because the margin requirement on a short strangle is the greater of the margin requirements between the two naked options, either short naked put or the short naked call. In this case, because the short naked put is slightly more expensive and closer to the money, that one's going to dominate. But selling the naked call doesn't add to the margin requirement, which is kind of nice. You can think about this as an alternative way of a covered call. I'm buying stock and selling a call. What's the difference? Well, I'm not buying stock in this case, but I am generating the positive deltas by selling a naked put. So selling a naked put is, if you think back, is, well, okay, that's a way of buying stock if I want to buy stock. I can sell the stock, sell the put. If the stock goes down, I'm willing to take delivery of the stock, and I'm long the stock at that point. But I'm short a call as well. So this is like a kind of a covered call trade. Not many folks are going to think of a naked strangle as a covered call. But in this case, if you're bullish on the XLE and you're happy selling that naked put, if you're comfortable selling that put and accepting that risk-reward ratio that you have with that position, consider selling that out of the money call to generate that extra credit. Now, you're not just picking any call. You're picking a call that has a high probability of expiring worthless and a decent level of credit, of premium that's going to offset the risk on the downside as well.
So, Tom, what we did here is we sold a 43 put, which is only $1.50 out of the money, and a 48 call, which is actually exactly $3.50 out of the money. So that's already skewed. The other thing is we put up no additional capital to sell the call because we already had the capital put up in the put. The other piece to it is we expanded our break-even price from 175 to 270.
Yes.
So all that stuff is neat. Now,
of course, you do have risk on the upside. If XLE, if there's another shooting war in the Middle East and oil goes back to $120, yes, there's extra risk on the upside.
So you trade this at a much smaller level, quantity-wise, and then is it a good trade or bad trade?
Well, I think it's a smart trade.
So it's a trade.
I think it's a good trade.
I agree
I think it's a smart way of speculating on a bullish bias for XLE.
Perfect. So what we've discussed here is two different trades to play the upside of XLE that both constitute good trade. One is an iron condor selling the 43, I'm sorry, in this case, selling the 44 puts and buying the 42 puts, and selling the 48 calls and buying the 49 calls. That's a skewed condor. You collect $1.03, you risk 90, you risk 97 cents. It has a 57% probability of success. Good trade.
Right.
Another good trade with significantly more risk, okay, but a much higher. You go from 57 chance success to almost a 77.5% chance success if you're bullish, is selling the 43 puts and then selling the 48 calls. It's like an iron condor without the cover.
Without the protection.
Without the protection. It's like you lifted a leg without the protection. So let me ask you. So you have a lot of people on today, they're saying, oh my God, that's crazy. I was taught never to do that. So let's just say, Tom, we consider those both good trades. The alternative is that, you know what, I think XLE is going to move, and I think the upside move is going to be huge. And I think right now, if I buy the out-of-the-money calls, which are the 45 calls in August, I can pay 210 or 212. Let's just say 210.
Yeah.
And I can buy the 43 puts because I'm bullish, but I just want to protect myself.
So
and
buying a strangle.
I can pay 178. So for the combo, I can pay $4.
Ooh.
So I can buy the strangle. I can buy the 43 puts and the 45 calls, and I can pay $4 for that. Good trade or bad trade?
Oh, boy. Well, I don't know if it's a good trade or bad trade, but I know what my break-even points are, and they're awfully wide.
Okay, so let's
And
talk
the
about your
probabilities
break-evens.
are a little bit low.
Okay, so the chance your break-even on the downside by expiration is your
If I'm paying $4 for that straddle,
Yes.
strangle,
it's $39 on the downside.
$43. It's the put strike minus the premium you pay. So 43 minus $4, $39. Probability of expiring below $39, about 20%, 21%.
So 80% chance of losing if you buy the strangle
On the
downside.
downside.
How about the upside? What's the chance of going?
Upside, 49.
Mhm.
20% as well.
20% as well. You know what? The option pricing, the matrix for option pricing, basically the whole option pricing model always comes out virtually the same way.
Yeah.
Which is why options have an 80% chance of losing if you're a net buyer. So the answer is, was it a good trade or bad trade? It's a bad trade. And the only reason it's a bad trade is because you have to have some kind of a monster move to beat the odds, which say there's a 80% chance of losing.
Right. And most of the time, the monster move doesn't happen. The worst thing in the world is to say, I've got this strangle on in XLE. And XLE noodles around for a month and a half, doesn't do anything. And your straddle gets cheaper and cheaper and cheaper and cheaper. And the day after expiration is when the world falls apart and oil goes to 80, 90 bucks again. Okay, or 100 bucks again. And XLE is up 10 bucks. Okay, that stinks. You have time working against you when you buy this sort of strangle. You can say, well, yeah, sure, but you know, if the XLE takes off or crashes, I can make a fortune. Well, of course. But the likelihood of that happening is so small that don't get suckered in by that sort of trade.
Okay.
Don't get suckered in by, don't get lured by the promises of vast riches.
So this becomes a great discussion today because nobody else in the world would cover this. This is so off base for anybody. I would be
for anybody talking to retail traders. That's the whole point.
Now, don't downplay what we're doing here because there's not another person in the free world that would talk about this.
No.
But so good trade is selling that skewed condor where your put strikes are closer than your call strikes, where you have defined risk.
And you're doing a 2-point put spread, taking extra risk on the downside in exchange for larger credit, and selling a 1-point call spread.
Good trade.
Good trade.
Another good trade. Selling the out-of-the-money strangle and assuming that you have enough capital. Instead of doing this 10 times like you might do with the condor, which ties up $1,000, you do this 1 time or maybe 2 times.
Yeah, maybe. You don't try to impress anybody by putting on huge size in this stuff.
Risk is
hit singles. Hit singles.
It's a notional. Risk is defined by basically we like to define risk through some notional equation. We can discuss that later on, but in this particular case it's essentially the margin required for the position. So if you wanted to use $1,500 for the trade, you do twice. If you wanted to use $1,000 or less, you do it once. So where you do 10 iron condors as defined by the risk, which is $970 in this case, you do 1 of these short strangles, which is defined by the risk, which is $750. It's essentially this dollar amount off of risk. Both are good trades. Bad trade would be use the same dollar amount, which is buying this out of the money strangle for $4, expecting the big move to happen, 80% chance of losing.
80% chance of that big move not
How
happening.
many times would you do it? You do it twice because that's $800. It's the same amount of capital.
Yep.
So-
And that probably wouldn't make money.
So here are 3 different ways to use less than $1,000, 2 of which are good trade, the short condor and the short strangle. One is a bad trade, the long strangle, and it just makes total sense.
That's right. And there's no mystery to this. You know, Tom and I aren't like, oh, well, Tom, what do you think about the sun? No, we're not doing that. We just have a bias in a particular stock or an ETF or something like that. We're looking at some of the probabilities, the free tools that you can access easily on thinkorswim.com. Take a look at them. Use them. Using this sort of stuff, and look, Tom and I aren't rocket scientists, okay? We're just kind of stitching this stuff together, but it makes sense. This is
public
how
school
we
graduates.
trade. What's that?
We're public school graduates.
We are, and proudly so. Proudly so.
This morning, one of my trading partners came up to me and said, Tom, I want to put this position on in Microsoft. I go, what are you doing? He goes, well, we're getting short Microsoft here. I'm like, stock just was at 40, 20.
You want to sell a call spread?
It was 20. You want to sell a call spread in Microsoft, and I'm like, listen, I have no problem with you wanting to sell the call spread. It's the right trade, but the stock was just. Where were you at $24 2 days? 2 weeks ago. Now it's at 22.40.
It was 22. Right.
Yeah, 22 and change. And I'm like, yeah, I don't like the trade. So even though the strategy was right, I didn't like the trade because of where the stock was. So there's all these different things that come into play. You have to find the underlying that you like. I really believe that most traders, retail or institutional, whatever it is, you've heard me say this many times, most traders are right. You must put on positions that give you a chance to be right. Now, I'll give you an example of this backfiring the other day. 2 days ago, I was really bearish in Goldman Sachs. I'll give you a little example here of it backfiring. Stock was trading for just around, I think the number was about 145. Well, it was up about $1.50. This was, I think it was 2 days ago. Stock was trading at about 145 bucks. Stock's up $1.50. And I sold some calls, and I was intending just to be short calls. Well, as the stock continued to rally, then it was up $2, then it was up $2.50, then it was up $3. And I'm like, oh God, this is a bad trade. Mm-hmm. So I ended up selling puts against my short calls. And I sold out of the money puts because I wanted to maintain a short delta. Well, I maintained a short delta, all right, which in 2 days became a very long delta, meaning that the stock went from 145 to 136 in about 2 days. So my brilliant idea of wanting to get short Goldman Sachs backfired because I went from short to long. And so because I was short premium. So sometimes that can happen. But generally speaking, most stocks don't move 6 or 7% in 2 days. And the loss, because I did it off notional risk, same thing. I just basically did it off regular FINRA margin requirements, pure customer margin requirements. My position was so small that on the close today, the stock rallied back a couple of dollars, and the position, even though it had all this kind of crazy delta, basically flattened itself out by the end of the day. Mm-hmm. So you know what? You have to put positions on that even, in the worst of circumstances, buy you enough time to be right.
Give yourself enough room. A lot of times you see people, especially if they're trading, let's say something like July options. July options are kind of like binary options at this point. They're either going to work or not work. You don't have any time for the stock to rebound or anything like that. Or, you don't have a chance. So give yourself some room. Push yourself out to the August expiration, for example. I wouldn't go out to October yet. It's got 100 days. That's a little too far. And, your predictive abilities of the bias for a stock or an index are a little bit, they start to decay a little bit. So I'd keep it around August. But there are so many trading opportunities out there. Like Tom said, Microsoft, you want to sell a call spread? Great. You should have done it 2 days ago. What else is out there? These are strategies you can apply to just about any index or stock.
So, Tom, we have a little more time left.
Just a little.
I know, but I'd like to do some more stuff here.
One more stock.
So, Apple.
Excellent choice.
So this is an interesting stock today. I'm picking a stock that was in the news because this stock was actually up a lot today. So Apple is AAPL, and Apple is 137, closed at 137.22. It's up a little bit.
Yep.
It's up a little after hours.
Yep.
Okay. Now the reason I picked Apple, Tom, is because one, it had a sell-off prior. Apple was one of the reasons that the NASDAQ turned around late in the day. Mm-hmm. But many will argue here that Apple is in a pretty good trading range. Let's call it 135 to 140 something. 135, 145, somewhere,
Yep.
132,
And right now it's
142.
right in the middle of it.
It's right in the middle of its trading range. So, and many of us think the market's in the middle of a trading range. I think we're at the low end of the range. Maybe it bounces back to, to the 890 level, 885, whatever it is. Maybe we break through to the downside here, but this is kind of the range I thought we'd be in. So I want to play Apple sideways, right? But I want to do something different than what we've done before. All right. So now, what I'd like to do is talk to you about a couple different spreads. First thing I want to do is talk to you about a calendar spread, because I want to take advantage of something going sideways. I want to take advantage of time. So the calendar spread that I was thinking of, all right, is to buy. I'm going to open up July. Let me just change these strikes real easy. July, August, and October. I'm going to open up 3 strikes here.
Yep.
So I was thinking of buying the July 135 calls, and I'm thinking of selling the August 135 calls. So what I'm going to do here is I'm going to right click on the July 135 calls, move my cursor to buy, and move my cursor over to calendar and left click on calendar. That pops in a 1-month calendar spread, July, August, for $48.80. It's kind of expensive, but I wanted to get your take on this. Would this be like an acceptable calendar spread? Is this a good trade by the way we teach calendar spreads?
Well, let's back up a second to say, how do we make money on calendar spreads? And that's by collecting money from the rolls. In other words, when we buy that short July option back and sell off the August option. And I haven't looked at Apple options closely enough recently, but I'm thinking $4.80. I'm not sure, even if we nail the strike at 135, if we get down to that strike, if the roll is going to be, let's say, $5. And even if it is, we're risking $4.80 to take in, let's say, even a $6 roll. That's a $1.20 profit on a $4.80 risk. I don't know, and that's us being really right.
Okay, but that's,
I don't like the trade.
Okay, but that's, you went into the analytical piece, but let's think about it from a criteria piece. First of all, we don't like to trade front month options and only have 9 days to go to expiration.
That's right.
Second of all, when we trade calendar spreads, we always do something that's out of the money because we want the fastest rate of decay on the nearest out of the money option. So we're going to close this up, and the July-August calendar spread in Apple, bad trade. What we're going to do then is we're going to close up July. We're going to go to the August. In this case, I'm going to go 1 strike out of the money because I think this is range bound. I'm going to go the August 140 calls. I'm going to move my cursor to buy, move my cursor over to calendar, left click on calendar, and the August October, which is August, September, October.
Yep.
The 2-month calendar spread in there.
Yep. Two opportunities for rolls.
Is $3.30. So it's cheaper. No, the 1 month was $4.80.
Right.
But in this case, the 2-month calendar spread, so there's 2 in there. So each month, let's just call it as $1.65.
That's right.
So instead of $4.80, we're paying $1.65. Now we went 1 strike out of the money.
Yep.
So this would be considered, now remember, the scenario is this. You think Apple's range bound. You think it's going to continue to go sideways. You think it's going to stay between 135 and 145. And you already know that this front month calendar spread can go to $5 because that's where it's trading right now, which means that a 2-month calendar spread could theoretically go to $10.
Right.
So you're paying $3.30 for something that could potentially go to $10 or $11 total. So you're risking 1 to make 3. And you're meeting all the criteria by selling the nearest out of the money option and doing the 2-month time calendar.
Right.
Good trade, bad trade.
Good trade.
Good trade.
Good
Exactly
trade.
right.
Smart trade. Smart trade.
So if you're a little bit bullish to range bound in Apple, think the stock's going to stay sideways, you don't ever do the July-August, you do the August-October. You do the 2-month wide for $3.30 as opposed to the 1 month wide for $4.80.
And our break-even points, if I look at this, are probably about 10 points around the strike.
Now, Tom, something else that we're going to teach people. There's a big difference between selling an out-of-the-money put in Apple and selling an out-of-the-money put in UNG.
Yes.
UNG is a $12 stock, and if you sell the 11 puts in there, and remember, it's a commodity stock as well. So it's not a bank stock, it's a commodity. And if you think that you're nervous about the risk, remember, the risk in a short put is the same risk as in a covered call. So essentially, you buy stock, you sell the money call, you're equivalent of short the put. In this case, if you sell the out-of-the-money put in UNG, it's a very high return on capital. It's a great risk reward. Now, Apple is not the same thing. And one of the things that we like to teach your customers is it's a very different set of risk metrics when your risk is $135 as opposed to $11. Right. So, for example, if you went and you sold an out-of-the-money put in Apple and you went to the August puts and you sold the August let's just say 125 puts,
25.
and you sold them for $3.35. Now you still have a very high risk reward from a probability model, but the difference is, let's just say something bad happens, and you can guess what something bad might be if it's assuming it's not built into the stock, but sales fall off the map. Verizon comes out with the next greatest thing.
Yeah, or Motorola comes out with an even better iPhone, or whatever. Take your pick.
Steve Jobs goes to work for Motorola because he likes their $4 stock better than their $130 stock.
He's going to do a stock swap.
Yeah, he's a Bill Parcells. Okay.
So all right. So how much you want to say? Apple goes down 10%. Apple goes down 15%.
Whatever it is. But the point being is that it's very different to take risk, to take naked short put risk on $130 stock. So my point being here is that it does matter stock price, because number one, you have to put up more capital. Number two, you have risk. So I'm very comfortable on here talking about, selling a naked put in a $12 stock with an $11 strike price. I'm not nearly as comfortable talking about a $140 stock.
And this is the reality of trading. Because there are some people out there who say theoretically, they're equal because the probabilities and the volatilities and yada yada yada, and John Merriweather closed another fund today, down because he lost so much money. And a lot of these geniuses,
so-called delicate geniuses,
will say there's no difference. That I look at my risk of Apple and it's a $137 stock and the volatility is actually lower than the natural gas. So I'm going to take that risk. But the bottom line is, for real traders like you who are trading your own money, price does matter. The real amount of risk you take does matter.
Tom, I talked to a hedge fund manager today. He said, "Have you looked at soybeans lately?" I said, "Yeah, I watch them. I actually have a tiny position on in soybeans." But I said, "I watch them. They're getting annihilated." He goes, "Yeah, they were down, 50 cents yesterday, down 15 cents today." He goes, "I'm getting killed. I'm loaded." I'm going, "Why don't you sell the out-of-the-money puts in there?" And now, because again, I look at soybeans very similar than I look to other commodity products. I said, "Just sell the out-of-the-money puts. You have a much better risk reward." He goes, "How does that work?" I go, "How much money are you managing?" He goes, "Just tell me how that works." I go, "How much money are you managing?" Because it scared the living daylights out of me that a professional manager, I'm thinking to myself, I'm about to do a chat this afternoon with 2,000 retail customers that understand this 12 times better than you.
Okay, who get this?
It's scary stuff. So manage your own capital and manage it smart. I mean, here's an example. I punched up Alcoa because we did a live trading session today.
Alcoa's earnings.
And, we were selling put spreads in Alcoa today. Now, again, only because the stock was oversold and the put spreads were rich and volatility was up to 123%.
Yep.
And so, that's a perfect example of something that meets the criteria. Now, you got lucky in that the stock bounced up after earnings.
Yeah, the stock's up 50 cents.
That's pure luck.
Absolutely. There was no foresight. There was no based on my analysis of the earnings and the cash flow, there was none of that.
You thought the stock was oversold.
Thought the stock was oversold. Saw that the put spreads had nice fat credits because the volatility was up. And you know what? It's worth a speculation. That's what it was.
I have learned a lot in 29 years of trading. One of the most important things is I don't care what anybody else does or thinks. I love listening to the stuff because it only makes me realize how good the technology that we built and the stuff that we teach is, because it's so logical. You can't beat logic. If you tell me something's going to happen, okay, I don't care. If you tell me this is a good play, because, in fact, I'll give you another example. And again, this goes back to the good trade, bad trade thing. But I'm doing a trade. I think I told the story once, but I'm doing a trade show in Florida, and this was last February in Orlando. It was the money show, and a customer walked up to me and he said, "Can you take a look at this? This stock has X amount of volatility." I think it was 350% volatility on a $4 stock with the out-of-the-money calls trading in the stratosphere. He says, "Why wouldn't I do a covered call in here?" And I looked and I go, "You're exactly right. You should, because from a risk-reward side, the logic is so strong that there's only 1 or 2 places you lose on a risk scale. So an 80% chance of winning with a 20% chance of losing just said to me, hey, this is a trade you have to make. I didn't even care about the underlying.
Right.
And if a customer walks up to me and says, hey, you know what? I absolutely love this stock because I know the guy that runs this, or I know the analyst that blah, blah, blah. I'm like, I don't even, it's in one ear and out the other. I couldn't even care less.
Right.
You make an argument, a fundamental argument. I mean, I listen to fundamental discussions. I listen to technical discussions. In fact, sometimes I like it because I think we get to that point. But the price action will tell you, or the price of the underlying derivatives sends an important message.
Right. The value of the options being rich or cheap because of volatility. And I'm not saying over or undervalued. I'm not saying that at all. I'm saying, are you getting a nice credit for selling them? Are you offsetting the risk of you're buying a $5 stock and selling it out of the money call and taking off a significant amount of risk because of the premium you're selling the call for? It's our directional picks, our analysis, not that we do a whole lot of fundamental analysis, isn't necessarily any better than any of yours. And you know what the bottom line is? If the pros were doing all this stuff, they wouldn't be losing 44% like some hedge funds. Okay, if they knew that much, had all the resources, they wouldn't be getting whacked like they have been. Your analytical abilities, your stock picking abilities are just as good as anybody else's. The difference is that you're learning how to implement these strategies in a little bit smarter way. Good trade, bad trade. And Tom, we built this piece of software. How many buttons did we push? How many pieces of software? We used like 3 or 4 pieces. Now, not to denigrate the rest of the software, there's some tremendous tools, but this is pretty straightforward stuff. It's not getting cued, it's not coming up with fancy arguments or anything, not saying, well, it's like telling a joke. If you have to explain the joke, it's not a good joke. These trades are very straightforward.
In fact, before you make a trade, just say to yourself, good trade, bad trade. I mean, is the chance of me winning better than the chance of me losing? If the chance of me losing is better than the chance of me winning, then I better have a 2-to-1 or 3-to-1 payout. So, yeah. Tom, is it a good trade if you have a 40% chance of winning, but a 3-to-1 payout? And the answer is, of course.
Yeah, if it's 3-to-1, yes.
Even if it's 2-to-1, it's a good trade.
Yeah.
But if it's a 50-50 shot and you got a 60% chance of losing, bad trade.
No.
And you can say that. You just say that to yourself, so you always set yourself up to win. I mean, it's very hard to sometimes do it. I mean, the easiest analogy is, you go to a restaurant, you sit down, you order something, you take a look at the food that comes, and you go, good trade, bad trade. If we do it every time we do anything in life. We go on a date, we go, good trade, bad trade. It's pretty simple, but we go.
And sometimes we should send it back to the kitchen.
That's right. But the flip side of all that is that we, when making trades, it's mathematical. It's very logical. It has the numbers just come up and slap you in the head.
When you have the tools. When you have the tools, it's
when you have the understanding.
And the understanding. Yeah. And it's hey, Tom is 4:33.
Okay, Tom. It was
fun. Have we exhausted them?
We have. We've tortured them enough with our give and take and picking up the other person's things. You're going to see trading pick up a little bit now, I think. We've had a decent sell-off. We're at the low end of the range. I think there's definitely earnings good earnings next week. We have expiration. We have, Google numbers. I think you're going to see a pickup in activity. I think you should start looking at putting on your August positions.
Yeah.
Tom, I just wish everybody a great, safe, long week, not long weekend, but just a weekend.
Rest of the week and into expiration next week.
That's right. Remember, start rolling your positions. You should be out of all your front month positions no later than Wednesday of next week.
Yeah,
you should already be establishing your August positions.
Start taking care of your stuff. Start looking to roll your calendars or buying back your cheap out of the money options. Take the risk off the table when the short options get cheap. And it's housekeeping. It's really housekeeping.
Have positive decay on that monitor page, please, please, please.
Please. We're asking you nicely.
We're begging you.
Folks, it was a lot of fun. Thanks, everybody, for joining us this afternoon.
Perfect. Thanks,
Say good night, Tom.
Good night, Tom.
Good night, folks. Bye-bye.